Hey everyone, welcome back to Corporate Decoder, the place where we make sense of corporate filings. Today we are going to check on Nuburu, a company specializing in high power, high brightness blue lasers. And if all that jargon wasn't enough, we get the joy of decoding their S1 report. Is it a good sign that they are trying to register more stock? Well, let's dive in and find out. This report signals a major shift. It's not just about lasers anymore, it's about how they are transforming into a new kind of company through acquisitions and new strategies. But remember to stay tuned for the real story. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. First off, this document is about reselling up to 20 million shares of their common stock. This is being done by a YA2PN LGTD, referred to as the selling stockholder, after an agreement was reached in May. The details of this agreement, called the Standby Equity Purchase Agreement or CPR, are key here. Nuburu basically has the option to sell shares to this YA2PN at certain times up to a total of $100 million. The price isn't fixed, which makes things a little complicated, but it's tied to the market price at the time they decide to sell. Now, Nuburu won't get any money directly from this resale of shares. However, they could receive up to $97 million from selling those new shares to the selling stockholder. If they get money from such sales, they plan to use it for working capital and to put their transformation plan into action, and it will be up to them to decide how to use the funds. Of course, there are risks involved, and we should look into those. One big one is not knowing exactly how many shares will be sold or the prices they will fetch. Market conditions will play a big role. There's also the risk that shares could be sold at different times, leading to different prices for investors. There is the real risk of dilution, where if a lot of new shares are issued, it could cause the stock price to drop. We should also keep in mind that we might not agree with how they decide to use the proceeds, or that they just might not get a significant return from it. It seems that for all this talk of growth and new strategy, Nuburu is not a large accelerated filer. It is defined as a non-accelerated filer, but also as a smaller reporting company and as an emerging growth company. It sounds more and more like Nuburu starting over instead of blasting off. Let's dig into their operations and see if this checks out. The company states very clearly that they have not been profitable and may not be able to get there. They talk about needing more money to keep things going. This is never a good sign. They are looking for growth through what they call strategic acquisitions and investments, but acknowledge they might run into issues there as well. Not being able to manage growth in our business at their long sales cycles could cause some cash flow issues. It sounds like things are going to take some time, and there's a real risk if they can't close sales fast enough. They anticipate that they will make some revenue from government contracts, and they state that if they don't, it would be bad. Looking at the document, there is no assurance that they will be able to execute on their business model. They even got a warning from the NWAS because they are not meeting requirements, and there is a limited availability of market quotations for our securities. Adding insult to injury, Nuburu won't be paying any dividends. This means you are relying solely on the increase of the stock price to get your investment back, and the company already mentioned that this is not likely. Let's check some numbers. Where we can see that revenue took a nosedive, going from $2,085 to $152,127. It's never good to see a 92% decrease in revenue. They talk about cutting costs and a furlough in the last 2 quarters. It sounds like this business has some significant risks for investors. They have multiple transactions for issuing more stock, which will dilute stockholders. They are going to need a lot more capital. They are engaging in a rapid succession of acquisitions, which makes managing them harder. They might face lawsuits, and these are just some of the risks. This document is missing beneficial ownership information for the last year, which is definitely odd and not ideal to see. That about sums it up for this S1 filing. It's clear Nuburu is in the middle of a major transformation, shifting strategies and looking for new opportunities. The company's strategy, as disclosed in the report, hinges heavily on securing new capital to both implement the plan and to make acquisitions. The main problem with this is it is not guaranteed to work. The risk factors mention a plethora of issues that all can happen and ruin this strategy. While there are no direct statements about management performance, the sheer number of risk factors related to basic business execution, combined with the decline in revenue and ongoing losses, does raise some serious red flags. It will be interesting to see if the future will shine a bright blue light upon this company's transformation. Alright, that's our breakdown of Nuburu's latest filing. What's your take on these numbers, and what they signal for the company's future. Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.